In this video, we will tell you the secret of what determines the 80% of your portfolio's final return and how you can influence it. And in the next few minutes, you're going to learn that you shouldn't blindly adopt what they tell you. Because many investors like to compare the performance of different asset managers. But let's go back to the basics for a moment, because it's impressive to see the difference this can make. Imagine that the asset manager is like a captain on a ship sailing on the unpredictable sea of the global economy. Although the captain can set the course and perform maneuvers, ultimately it is the force of the ocean that propels the ship forward and determines the returns, not the captain himself. So the wealth manager does not determine returns, but the global economy propels you from returns. And what many investors do not know is that as much as 80% of their returns are determined by their asset allocation, that is, the division between stocks, bonds, and cash. And if you apply this correctly, investing suddenly becomes so much more fun. Well, what I mean by this, I'm going to tell you later. But first, let's dive into the data behind my computer to take you to a valuable sheet. Because in this sheet, you see the MSCI World Index over the past 34 years. And the MSCI World Index is a global stock index that represents the performance of large and medium-sized companies from the 23 developed countries. Plus, it's one of the most widely used benchmarks for global equity markets. Because this is what is pretty special and a big pitfall in investing. Because we as investors focus primarily on risk. This is just how our brain is set up. So you have to be careful about this, because negative news sticks better than positive news. And it is confirmed every day when you turn on the news. Well, back to the data, because you can see in the picture the difference between a bull market. And a bull market is an up market of more than 20% in a year. And a bear market is a falling market of more than 20% in the minus, in a market where the economy is in crisis during. And that's why it's so important to know this. Because if you're going to invest, it's important to be aware that the economy is rising more than it's falling, and that the rising market often lasts many times longer. And this is a bizarre statistic that not many investors know, but over the last 40 years, the market is rising 75% of the time. So in 25% of the cases, the market goes down. Because when you see these statistics like this, then really everyone wants to invest fully in stocks, right? Because the average time you're in a bull market, meaning an up market, over the last 34 years was an average of 7.5 years. And the average time you were in a bear market, that is, a down market, where the market drops more than 20% in a period of time, was an average of 1.5 years. But most investors who start investing find investing somewhat exciting, because with investing, you can lose your deposit. And this makes complete sense. But that's why it makes sense to dive deeper into this data, because this is not rocket science and I try to keep it as simple as possible for you. Alright, let's dive deeper into the concept of risk. Because when you start out as an investor, you have to make a choice of what percent you want to invest in stocks and what percent you want to invest in bonds. And most parties show you this statistic. Alright, what do you see here? This is the asset allocation, so the allocation between stocks and bonds over a period of the years from 1926 to 2015. If you had been fully invested in bonds during this period, you would have lost in the worst year and gained in the best investment year at an average of 5.4% per year. If you had invested entirely in stocks, over the same period you would have ended up with the worst year minus 43.1%, and the best year would be 54.2%, with an average of 10.1% per year. Okay, next you get to take a preference in your mind as to what would suit you best. So do you go for the blue profile, 100% in bonds, or do you go for the red profile with 100% in stocks? Or do you go somewhere in between? For example, this could also be a 50-50 ratio, right in the middle. Keep it in your mind for a moment, because I'll come back to that later. Have you chosen? Well, I'll let you in on a secret, because most investors choose a 50-50 profile because they don't want to lose more than 22.5% in returns. And this makes complete sense, right? Indeed, no one ultimately wants to lose money. But then, when you do have to make a choice with a certain probability of losing, they usually sit in the middle. Alright, listen up, because now let's take the same chart, but not focus on short-term risk, but look at what investing does in the long term. After all, you're going to invest for the long term, right? Okay, this is a similar chart from the year 1950 to the year 2016. This is a slightly different duration, but the story remains exactly the same. Alright, what exactly do you see here? We see that stocks are depicted in the color green, and in the short term have a risk of 39% to lose your wealth. And so with bonds in blue, you have an 8% risk of losing your wealth in the short term. And if you were invested in this period in a 50-50 allocation, you could have ended up at minus 15% in a year. But here's where it gets interesting, because if we extend the horizon to a 10-year horizon or even a 20-year horizon, you see that as your horizon progresses, your chance of a negative return gets smaller and smaller and smaller. So if we have a horizon of 20 years or longer, you see that in the period from 1950 to 2016, you would not have made a loss in equities. So the longer your horizon, the less likely you become to have a loss if you invest in stocks. But anyway, Maurice, I'm 70 years old and I don't have a 20-year horizon. And then I always say, is that really true? Because the money you invest at age 70 is usually meant for the next generation with a completely different horizon. And this, of course, depends on your personal situation. But as mentioned earlier, the choice of allocation between stocks and bonds ultimately goes for 80% of your return care. And this is all not that difficult, because the asset allocation is simply the distribution among the different types of investments such as stocks, bonds, and cash. So let's do this for fun. Do you remember what ratio you had taken in terms of asset allocation? Did it happen to be the 50-50 ratio? Well, that makes sense, as most investors choose this ratio. But in this example, you can already see that if you had chosen a portfolio with stocks and had started with 100,000 euros, then after 20 years, you would have 823,000 euros together. Whereas in a 50-50 ratio, that would have been 553,000 euros. This is a difference of no less than 270,000 euros in 20 years. And if you have a horizon of 20 years, and you know that the average return would have been between 7 and 17%, your choice would probably have been very different, right? In short, keep in mind that you are investing for the long term, and asset allocation makes a big difference in the final outcome. The important message I want to drive home here and get you thinking about is the following. What allocation best suits your situation? And so, don't blindly choose a 50-50 ratio just because you are at risk in the short term if you are investing for the long term. The choice in your asset allocation is determined by more factors than 20-year horizons and depends largely on your wealth plan, which you make in advance. And this video is mainly to challenge you and make you think carefully about the right asset allocation that suits you and your wealth plan. Plus, we indicate that 80% of your returns are determined by your asset allocation. While this fact is true, we see that the percentage gets significantly lower the moment an investor chooses the wrong asset manager. See, if you choose the wrong manager, this can make a big difference for you in your final return, because we see differences of more than 15% in the same year in a similar risk profile. And know that there are many so-called professionals in the market with wonderful marketing stories, and who are there mainly for themselves. So be warned. So make sure you have a good wealth plan with the right asset allocation that suits you, and make sure you select a good asset manager or do it yourself through do-it-yourself investing. See you in the next video, where we are going to talk about why 80% of investors lay behind in their returns.